Welcome back to Alpha Recap. Allison here, and we are unpacking the biggest market stories from today. As always, if you have questions, you can reach us at stockalpha.ai and ask us anything. I've got Kate with me, our fixed income specialist, to help make sense of the headlines. Kate, great to have you.
Thanks for having me. Excited to dig in.
All right, let's kick off with the three headlines that really drove the tape. UnitedHealth posted a big earnings beat and lifted guidance. TSMC surprised with a 77% profit jump and pledged a $100 billion expansion in Arizona. And Micron kept everyone arguing about whether memory is peaking or still undervalued. Big day.
Huge day. Each of those headlines mattered in different ways, and together they created a pretty complex risk-reward picture by the close.
So, UNH first. They reported second quarter earnings per share of 7.12 versus a consensus of about 5.18, and then raised their full-year outlook. That's the classic beat and lift. What does that signal, Kate?
Well, when a major insurer like UnitedHealth beats by that margin and raises guidance, analysts are forced to update loss assumptions, membership trends, and reserve usage. In plain English, it suggests claims may be running lighter than expected, or pricing and cost controls are working better than models assumed. That can shift allocation toward healthcare in the near term, because it implies steadier cash flows.
So it's not just a one-off pop in the stock. It actually affects how people model the whole sector.
Exactly. Analysts will rerun actuarial models, and if that improvement looks durable, it changes near-term earnings expectations for other managed care names too.
Got it. Now, TSMC, huge headline, 77% profit jump, and then this $100 billion pledge for Arizona. That feels structural. How did markets interpret that?
TSMC's profit surge was read as confirmation that demand for advanced nodes and AI infrastructure is real. The $100 billion US buildout pushes the narrative from forecast to deployment. It signals re-regionalization of chip supply chains and more onshore capex. But it also raises questions about execution, labor costs, and higher fixed costs in the US over many years.
Right. Big upside for AI capacity, but potentially higher capital intensity and margin pressure down the line.
Yes, analysts will be reworking capex schedules, depreciation, and free cash flow assumptions to see how this plays out under different demand scenarios.
Okay, Micron. It seems like every note today circled back to the memory cycle. Some valuation scenarios and coverage were wild, like 618%, 568%, 168%, but also tiny numbers like 0.14% and 4.8%. That's bonkers.
Honestly, I was a bit surprised by how extreme some of those outcomes were. But that variety tells you that Micron's valuation is extremely model sensitive. Memory cycles flip quickly. If demand stays strong, upside can be large. If inventory unwinds or demand softens, downside can be sharp. It makes Micron a major driver of semiconductor beta.
So Micron becomes the litmus test for how confident people are in the memory recovery. Short-term traders love that volatility. Longer-term allocators get nervous.
Right. It forces people to use scenario analysis rather than a single point estimate.
The cross-cutting themes from today are interesting. Tech and semiconductors still leading, concentration and valuation rotation in large growth names, Fed policy credibility, and geopolitical and regulatory headline risk. Kate, walk us through the Fed and credibility angle.
Policymakers matter. Dallas Fed President Lori Logan said she wanted modestly higher rates, and Fed Chair Warsh faced questions in Congress about inflation credibility. When those hawkish voices grow louder, the market prices a higher baseline for rates. That raises the required return on equities, especially long-duration names, and it can compress extended multiples.
So even with company beats, hawkish Fed rhetoric can limit how much multiples expand. That's a tension right there.
Exactly. Earnings beats can lift sector expectations, but policy risk can cap valuation expansion.
We also had geopolitical noise. Iran warning over the Strait of Hormuz after the U.S. set a one-week timeline for potential strikes. And regulatory probes, like the CFTC, looking at alleged trades with more than $90,000 in platform profits on a prediction market. Those are pretty disparate sources of risk.
They are. The Gulf headlines lift risk premiums in energy and shipping almost instantly. And the Kalshi-style probe, even though the dollar amounts are modest, shows how operational or reputational issues can drive compliance costs and volatility in niche fintech spaces.
Not a great day to be short headlines, I guess.
Nope. Headline risk has been elevated, so hedging and scenario planning became more valuable by the close.
Quick reactions. Short ones. Wow.
That's huge.
Right. And the other thing is, interestingly, coverage noted the Magnificent Seven have their lowest relative valuations in a decade, and Apple was being discussed as a near-monopoly cash engine with a cited valuation figure in the coverage. So there's a rotation story too, yes?
Yes. Lower relative multiples on big growth names can invite reallocation back into those stocks, even while idiosyncratic risks remain. Analysts note that this kind of concentration can create crosswinds, flows into a handful of leaders, but bigger macro or policy shocks can move markets fast.
Let's touch on where analysts agreed and disagreed today. Agreement was that UNH and TSMC mattered for allocation, and Fed rhetoric mattered for markets. The big disagreement was Micron and how to read TSMC's Arizona pledge, bullish for onshoring or a capital-intensive risk. And GE had a mixed reaction despite raising guidance. Walk us through that.
For Micron, you had one camp saying it's still cheap under reasonable scenarios, and another camp warning the memory cycle might be peaking. For TSMC, some analysts cheered the strategic importance of onshore capacity and more durable capex, while others warned a $100 billion program could add multi-year execution risk if macro slows. And GE illustrates you can raise adjusted earnings guidance, yet show slowing orders. That raises questions about earnings quality versus order momentum.
So headline beats don't automatically mean durable strength. You've got to look under the hood.
Right. And that's where scenario modeling and short lists of indicators help.
Okay, let's be practical. For different investor types, what did today imply? Start with conservative, income investors.
Income investors were talking about TIPS again. Coverage framed TIPS as a bond deal of the decade given current real yields, and they cited about 2.1% on a headline basis. For someone focused on protecting purchasing power, TIPS lock in a real return. At the same time, UnitedHealth's guidance lift suggests steadier healthcare cash flows, which matters for income-oriented allocations. But remember, further hawkish Fed rhetoric could still push yields up and affect bond prices.
Growth and AI investors?
TSMC's surprise and U.S. CapEx plan reinforced the secular AI and semiconductor argument. But Micron's central role is a reminder that memory cycle volatility is a tail risk. Models for AI supply chains should incorporate inventory and end-market substitution scenarios.
Value and cyclical folks?
They were focused on order books and earnings quality. GE's guidance uptick, but cooling orders, is the perfect example of why you separate reported earnings from forward momentum. Order trends matter for industrials and cyclical exposure.
Short-term traders and event-driven players?
Today underscored elevated event risk. Earnings and conference calls, plus geopolitics, make for more tactical volatility. That's opportunity if you can handle execution risk, but it's not without danger.
Risk managers?
They should be running hedged scenarios. Fed hawkishness, Gulf tensions, regulatory probes, and concentrated tech leadership all raise tail risk. Stress testing and explicit position sizing rules become more useful.
Before we wrap, what are the specific indicators people should watch next that will resolve some of these debates?
Key ones. Watch DRAM and NAND spot prices. Inventory days at OEMs. and data center server build rates to resolve the Micron debate. For TSMC, supplier order flows and equipment lead times will indicate whether the Arizona plan translates into near-term demand. On macro, CPI and PCE prints plus Fed commentary will tell us if hawkish rhetoric becomes policy. And geopolitics, any movement around the Strait of Hormuz would immediately affect energy and shipping risk premia.
That's a solid checklist. 2 quick tactical considerations analysts suggested were to refresh scenario models with base, hawkish, and geopolitical stress cases, and to prioritize a short list of high-info indicators. Liquidity and hedging were also emphasized. Any final notes on that?
I would add that given the model sensitivity we talked about, using conditional outcomes and maintaining explicit stop and position size rules can help manage the headline-driven swings we saw today.
Okay, time for our bottom line takeaways. 1. Company beats from UnitedHealth and TSMC mattered beyond the individual stocks. They changed sector earnings expectations and reinforced a CapEx and AI narrative. 2. Micron remains the market's wildcard. Valuation outcomes are highly model dependent, so it's driving semiconductor beta. 3. Fed credibility, Gulf tensions, and regulatory probes raised the bar on risk. Those macro and geopolitical themes can amplify volatility even when company fundamentals look strong.
And to add, for fixed income watchers, tips and real yields are back in focus. And for allocators, explicit scenario planning and targeted indicator monitoring are more valuable than ever.
Perfect. Quick reactions. 2 short ones. Wow.
Yeah, that tracks.
All right, everyone. That wraps our recap. If you want deeper dives or to send us your questions, head to stockalpha.ai. You can ask us directly in the Q&A feature, and we'll answer live. For more written market analysis and resources, visit stockalpha.ai. Thanks for listening. I'm Allison.
Thanks. Kate here. Appreciate you all listening, and we'll see you next time.